Taxpayers intent on evading federal taxes have invented numerous schemes to hide income from the Internal Revenue Service. One example is what the IRS calls an installment sale bogus optional basis transaction, or iBOB. In an iBOB, a taxpayer uses a network of entities he or she owns or controls to artificially increase an asset's purchase price, or basis. This reduces or eliminates capital gains taxes when the asset is sold. How iBOB schemes work is well known to the IRS. This video explains these schemes and the challenges IRS faces in ensuring those who are engaged in such schemes are caught. Let's say Mr. Jones has a network of related entities. He is a 99% partner in Jones Co., which in turn is a 99% partner in New Co. The other partners in these partnerships may also be entities in Mr. Jones's network. New Co. owns a single asset, a hotel, which was purchased for $120 and is now worth $200. This means there would be a capital gain of $80 when the hotel is sold. Jones Co., as a 99% partner in New Co., has a basis of about $119 in New Co. and would be entitled to $198 of the hotel's value. Mr. Jones wants to sell the hotel and evade the taxes on most of his capital gains. Mr. Jones causes Jones Co. to sell its 99% partnership interest in New Co. to another entity he controls, the Family Trust. In return, the Family Trust signs a note agreeing to pay $198 in installments to Jones Co. The $198 becomes the Family Trust's basis in New Co. If the Family Trust were truly independent from Mr. Jones, he would have a reason to make sure the Family Trust made the payments, and Jones Co. would report the payments to IRS. When all of the installments were made, Jones Co. would have paid the capital gains tax on the difference between the $198 sales price and its basis of $119. This difference is $79. But in the iBOB, the installment payments are never made. The Family Trust is simply a straw man inside Mr. Jones's network used for triggering a basis adjustment. The fictitious sale permits the New Co. partnership to step up the basis in the hotel to $198 for the new partner, the Family Trust. In other words, the trust's share of New Co.'s basis in the hotel rises from $119 to $198. Not only does the fictitious installment sale to the trust improperly raise the trust's share of New Co.'s basis in the hotel, but it adds complexity that would make it difficult for IRS to follow the flow of funds during a potential audit. When New Co. finally sells the hotel to Mr. Brown, a party outside of Mr. Jones's network, for $200, Mr. Jones's Family Trust pays no capital gains taxes because its share of the basis in the hotel and its share of the sales amount match at $198. The government loses nearly all of the potential tax due on the sale from Mr. Jones's network. In the real world, iBOBs could be much more complex by having many layers of network transactions between the installment note being made, the bogus basis adjustment, and the actual sale of the asset. Taxpayers also may let years pass between the basis adjustment and the sale. Performing transactions among many commonly owned organizations and spreading those transactions out over time are typical of the challenges IRS faces in addressing network tax evasion.